Most traders lose money on the entry itself, not the exit, not the position size, the entry. This is the brutal truth that separates the amateurs from the professionals, and it costs the average retail trader somewhere between $40,000 and $120,000 per year in blown accounts. Think about that number for a moment. That's a car. That's a down payment on a house. That's a year's salary for millions of people, vanished into the market because they couldn't master the single most important skill in trading, knowing when to actually get in. Here's what separates the amateurs from the pros. Amateurs enter on hope. They see a setup forming, their heart rate rises, and they convince themselves that this is the one. This is the move that will make them rich. They don't wait for confirmation, they wait for permission, and permission in their mind comes the moment they feel like the trade is right. Professionals, on the other hand, enter on confirmation. They don't care about how the setup feels. They care about what the market is telling them. And the difference between those two mindsets, between hope and confirmation, is the difference between losing money every single month and building wealth with mechanical precision. Jesse Livermore didn't just trade price action. He read the tape like a priest reads scripture. Every single bar told him a story. Every volume spike, every rejection, every close above or below a key level, it all meant something. But he had a rule so simple, so devastatingly effective, that most modern traders skip right past it without even recognizing its power. They think it's boring. They think it's too slow. They think they're missing the move while they wait. They're wrong, completely wrong. And their blown accounts prove it every single month. The rule is called the two-bar confidence trick, and it's about patience in its purest form. It's not about waiting for the perfect setup. Perfect setups don't exist. Markets are chaotic. They're unpredictable. They're designed to shake out weak hands and punish early entries. This rule is about waiting for the one thing that actually matters. The confirmation that separates the scared money from the smart money. The confirmation that tells you real institutional capital has actually stepped in, not just retail fear of missing out creating a false spike that's about to collapse. Today, I'm going to show you exactly how Livermore used this principle to enter trades with such certainty that he could size small and let winners run for massive gains. No second guessing on the entry. No revenge trading when the first bar didn't work out. No emotional roller coaster where you're up $500 one minute and down $1,200 the next. Instead, you'll have a mechanical rule so objective, so detached from emotion, that your psychology becomes almost irrelevant. You'll enter when the rule says enter. You'll exit when the rule says exit. Your feelings won't matter. But first, you need to understand this foundational principle. If you can't get the entry right, nothing else matters. Your stop loss is worthless. Your profit target is a fantasy. Your position size becomes Russian roulette. You could have the perfect risk-to-reward ratio, but if you're entering at the wrong time, on the wrong confirmation, you'll lose money anyway. You'll be fighting the tape from the moment you hit the buy button. You'll be swimming upstream. You'll be at war with market structure itself. The amateur thinks like this: I see the setup forming. The price is approaching resistance. It looks like it's about to break. I should get in now before I miss it. And so they enter early. They enter on hope. They enter on anticipation. They enter on the expectation that the move is coming. But expectation and reality are not the same thing. The move might come, or it might not. And if it doesn't, they're stuck holding a losing position with no conviction, no edge, and no reason to believe it will work out. The professional thinks like this: I see the setup forming. The price is approaching resistance. But I'm not entering yet. I'm going to wait and see what the market actually does when it gets there. I'm going to wait for the market to prove to me that this move is real. That's the confirmation I need. And so they wait. They sit on their hands. They feel the pain of watching the move happen without them for one bar, maybe two. But they're not emotionally invested yet. They're not down money. They're not desperate to be right. That proof, that moment when the market actually shows you it's serious, that's the two-bar trick. That's what this entire video is about. By the end of this script, you will know the exact pattern Livermore used to enter with zero doubt. You'll understand why waiting for just 2 bars often means the difference between a 1% gain that you second-guess yourself out of and a 300% run where you hold with absolute conviction because you know the entry was real. And you'll have a rule so mechanical, so objective, that emotion becomes not just optional, it becomes impossible. You won't be able to doubt yourself because the rule will have already decided. The question you need to answer before we go any further, before I break down the exact mechanics, is this. Are you willing to miss 30% of a move to catch 70% of it, with absolute confidence? Are you willing to sit out the early volatility, the noise, the false breakouts that blow up amateur accounts? Are you willing to sacrifice the rush of being in early, if it means you can enter with such certainty that you can size properly and let your winners run to 3 times, 5 times, even 10 times? If the answer is yes, if you're ready, T. Oh, think like a professional instead of hoping like an amateur. Then keep watching. This changes everything, not just your trading, your entire relationship with the market. Before the internet, before algorithms, before retail traders had access to real-time level 2 data and order flow visualization tools, Jesse Livermore sat in a bucket shop with nothing but a pencil and a pad, reading the tape, not the price itself. He didn't care as much about the numbers. He cared about the action, the movement, the behavior of money. He watched how price moved, how fast it moved, when it accelerated, when it stalled, when it reversed. He was reading the psychology of the market in real time, decoding the intentions of the money that actually mattered. Here's what most modern traders fundamentally misunderstand. Price doesn't move because it wants to. Price doesn't move because of some cosmic force or random walk theory or efficient market hypothesis. Price moves because institutions are moving it. Banks, hedge funds, market makers, pension funds, large proprietary trading firms. They don't care about your technical analysis. They don't care about your moving averages or your Fibonacci retracements or your chart patterns. They care about one thing: where are the stops? Where will the retail traders have placed their protective stops? Where can we break resistance to trigger those stops? How much retail money can we shake out before the real institutional move begins? This is the game that's been played for over a century. Livermore understood it. Most traders never do. The tape, the order flow, the bid-ask spread, the volume profile, the sequence of prints tells you exactly where those institutions are positioning themselves. It's the only truth in the market. Everything else is noise, interpretation, or hope. The tape is objective. The tape is honest. The tape never lies. But RS never listened to it because listening requires patience, discipline, and the willingness to miss moves. Here's the fundamental contrast. Amateurs read a chart and see a breakout. They see price above a key level. They see the bar close above resistance, and they think, that's my signal. That's the confirmation I need. Get in. They confuse movement with meaning. They confuse a price spike with institutional accumulation. They see the first bar break the level, and they're already mentally counting their profits. Professionals read the same exact chart and ask a completely different question. Did real money actually step in, or is this just retail chasing the move, panic buying, fear of missing out, creating a spike that's about to collapse? They're not looking at the breakout. They're looking at what comes after the breakout. They're looking for the institutional follow-through that separates a real move from a fake move. The 2-bar trick answers that question with surgical precision. It's not complicated. It's not subjective. It's mechanical. Here's the core principle that changes everything. A breakout means absolutely nothing until the second bar confirms it. The first bar is the trap. It's the bait. It's designed to catch amateurs. The second bar is the truth. The second bar is where you see if real money actually wants to own this asset, or if the spike was just emotion. Think about it like this. A trader is watching a chart. They spot a key resistance level. Maybe it's a previous high. Maybe it's a round number. Maybe it's a moving average. Price approaches it. The trader gets ready. Price prints a bar and breaks above the resistance. The retail crowd panics. They're afraid of missing the move. They panic buy. Amateurs pile in. Everyone's buying. The first bar spikes higher on pure emotion, pure fear of missing out, pure desperation. It's loud. It's fast. It feels real. It feels like the beginning of a massive move. Then the second bar opens. This is the critical moment. This is where the tape tells you the truth. Real volume either comes in or it doesn't. Real buyers either show up or they don't. Institutional money either steps in or it doesn't. If real money steps in on bar 2, if the institutions actually want to accumulate at this breakout level, then price closes higher and holds above the resistance level. That's confirmation. That's the moment the professional enters. Not on the breakout, not on the first bar, on the confirmation of the second bar. By this point, amateurs are already in, already sweating, already starting to doubt themselves. The professional enters with the conviction that comes from seeing institutional money step in. If real money doesn't step in, if the institutions are selling into the retail panic, then price stalls on bar 2. It doesn't accelerate, it creates a false high, and then collapses. The amateur who entered on bar 1 is now stuck in a loser. He's down $300, $500, $1,000, whatever his position size is. He's emotionally devastated. He's thinking about revenge trading, he's planning his comeback. The professional who waited? He never took the trade. He watched the trap spring. He saw the fake breakout fail. And he moved on to the next setup with his capital intact and his psychology unharmed. This is why Livermore called this concept waiting as a position. It sounds passive. It sounds like you're doing nothing. It actually sounds lazy. But it's the opposite. It's the most active, most disciplined stance in trading. You're actively choosing not to trade. You're actively resisting the fear of missing out. You're actively preserving your capital and your psychology for the moments when the setup is actually real. The maxim Livermore lived by is this: the first bar lies, the second BA. R tells the truth. It's simple. It's quotable. It's worth memorizing and repeating to yourself every single trading day. The first bar lies. The second bar tells the truth. Every fake breakout starts with the first bar that looks convincing. Every real move is confirmed by a second bar with institutional follow-through. Here's what happens when you adopt this rule and actually stick to it. Your total number of trades per month will drop significantly. You'll enter fewer positions. Where you used to take 20 trades a month, you'll take maybe 5. That feels uncomfortable at first. Your brain is telling you that fewer trades equals less money. It doesn't. Your win rate, the percentage of trades that are profitable, will actually drop too. Where you used to have a 50% win rate, you might drop to 45%. That also feels wrong. But here's the payoff. Your average winner will triple. Your average winner will go from 1% to 3%. That's the magic of trading only confirmed breakouts with institutional follow-through. Every trade that passes the 2-bar trick is higher probability. Every trade has real money behind it. Every trade has conviction. The math works out dramatically in your favor, even with fewer trades and a lower win rate. And that's the secret Livermore discovered over a century ago. Sitting in that bucket shop with his pencil and his pad, watching the tape and learning to separate institutional truth from retail emotion. Now, the protocol. This is where theory becomes actionable. This is where the abstract principle of waiting for confirmation transforms into a mechanical rule that you can execute the same way every single time. No interpretation, no subjectivity, no room for emotion to creep in and ruin your discipline. 4 steps, that's all it takes. A pivotal point is not some random level on your chart. It's not just any support or resistance that looks good. A pivot. Tall point is a price level where the market has made a decision before. It's a price where institutions have actually fought, and one side won decisively. This could be a 20-day high. It could be a weekly open. It could be a previous swing high or swing low from last week. It could be a round number where banks have historically defended. The key is that this level has institutional significance. This is not a level you invented. This is a level where the market has already shown you that something important happens. Why does this matter? Because when price approaches a pivotal point, the institutions are already watching it. They know where it is. They have orders queued up. They have plans. When price breaks a pivotal point, you're not trading a random setup. You're trading a level where real money is positioned. You're trading where the game is actually being played. Price approaches your pivotal point. Your heart starts to race. You can feel it coming. Price prints a bar and breaks above or below your pivotal point. Bar 1 is printed. It's volatile, it's loud, it's screaming at you. The move is happening. You're missing it. This is the moment. Your hands are hovering over the keyboard. Your finger is on the buy button. Everything in your body is telling you to enter right now. You do nothing. Your hands stay off the keyboard. You sit on them if you have to. This is the hardest part of the entire protocol. This is where 95% of traders fail. They can't do nothing. They can't sit still. They can't resist the call of the move. But you do. You wait. You watch bar 1 print its spike, its energy, its false promise. And you wait for bar 2. Bar 2 opens. This is the critical moment. This is where the tape reveals the truth. This is where you discover if real money actually stepped in, or if retail emotion created a spike that's about to collapse. You're looking for 3 specific things. All 3 must be true. Not 2 out of 3. All 3. First, did the bar close in the direction of the breakout? If you're watching an upside breakout, did bar 2 close higher than bar 1? Or did it close lower, showing weakness and reversal? Amateurs miss this. They see bar 2 open higher and think that's confirmation. But where did it close? That's what matters. The close reveals institutional intention. Second, did volume increase versus bar 1? Real money comes with volume. Real institutional accumulation shows up as a volume increase. When the second bar prints, does it come with more volume than the first bar? Or does volume dry up, showing that the institutions are actually selling into the retail panic? A second bar with declining volume is a death knell. It means the move is running out of fuel. It means the trap is about to spring. Third, did price hold above or below the pivotal point? This is the simplest check. After bar 2 closes, is price still above the resistance level you identified? Or did price dip back below it during bar 2? If price closes back below the pivotal point, the breakout has failed. It's a fake breakout. There's no confirmation. If all 3 conditions are met, directional close, volume increase, price hold, then you have confirmation. That's your entry trigger. You enter on bar 2's close or on bar 3's open. Not before, not during bar 2, at the close or at the open of the next bar. By then, amateurs have already been in for multiple bars. They're already sweating. You're entering with fresh conviction because you have objective proof that real money stepped in, because you waited for confirmation, because you entered only when institutional money had already shown up. You can size small and let the winner breathe. This is the paradox that most traders never understand. By waiting longer, by being more selective, you can actually risk more per trade because you have higher conviction. You can take a larger position because the probability is higher. You can let it run because you're not emotionally invested in being right on the entry. You're not desperate to make money back. You're not revenge trading. You're executing a plan. Amateurs who entered on bar 1 are fighting for break-even. They're in a position that they have no conviction in. They're sweating, they're second-guessing. They're planning their exit at break-even so they can get out and move on. You're building conviction because the entry was real. Here's a concrete scenario to cement this. Gold is trading around $2,040. There's a key resistance level at $2,050. This is a 20-day high. This is a pivotal point. Institutions are watching it. You identify it, you wait. Price approaches. Price breaks above $2,050. Bar 1 prints. It's a $15 spike. Gold closes at $2,055. Every amateur trader in the world is buying. The move feels unstoppable. Everyone's in. The move is happening without them, so they panic buy. The first bar is a monster. Massive volume, massive move. It feels like the beginning of a $200 rally. Bar 2 opens. You're waiting. Bar 2 gaps higher initially. It looks like it's confirming. Then something happens. The volume that came in on bar 1, it's gone. Bar 2 is printing on half the volume of bar 1. Price is drifting. It's not accelerating. It's stalling. Institutions are selling into the retail panic. By the close of bar 2, gold is back down to $2,052. It's almost back to the breakout level. The bar closed lower than bar 1. Volume dried up. Price is barely holding above the pivotal point. That's a failed breakout. The confirmation never came. Bar 2 told the truth. Real money never actually stepped in. This was retail panic, not institutional accumulation. The amateur who entered on bar 1, he's down $300. He's already thinking about revenge trading. He's thinking about doubling down. He's thinking about holding and hoping gold eventually goes higher. He's emotionally compromised. The professional who waited for bar 2's confirmation, he never entered. He watched the trap spring. He saw the fake breakout fail. He's emotionally fresh. He has capital. He has conviction. He has psychology. When gold collapses back below $2,050, he's ready to short the reversal. He's ready to trade the failed breakout in the opposite direction. The 2-bar trick cost him nothing. It saved him thousands. It preserved his capital. It preserved his psychology. It kept him in the game. That's the power of the mechanical rule. That's the edge Livermore discovered. 4 steps, no interpretation, no emotion, just discipline and the patience to wait for real confirmation. Here's where most traders, especially the ones who watch a few trading videos and think they understand the game, completely misunderstand Livermore's entire approach. They watch him wait for confirmation, they watch him pass on trades, they watch him have months where he makes 0 entries. And they think he was conservative. He was afraid. He was risk-averse. He didn't have the guts to pull the trigger. The opposite is true. Completely, diametrically opposite. Livermore was aggressive in his conviction and patient in his execution. And here's the critical insight that most traders never grasp. Those aren't contradictions. They're the same thing. They're two sides of the same coin. You cannot separate them. The patience is the aggression. The selectivity is the confidence. Because he waited for confirmation, because he only entered when the 2-bar trick had validated the setup, Livermore could size much larger on his entries. He had fewer trades overall, but when he pulled the trigger, when the confirmation came and the institutional money showed up, he was all in. He was committed. He knew the odds were in his favor. He knew the risk to reward was worth the position size. The amateur trader, on the other hand, is terrified of missing the move, so he sizes small on every single entry. He takes 100 trades per year, but on 70 of those trades, he's only risking $500 because he's not sure. On 20 of those trades, he's risking $1,000 because maybe, possibly, he thinks this one might work. On 10 trades, he's actually committed and sizing properly. Over the course of 100 trades, his average position size is only 50% of what it should be. He's bleeding opportunity cost. He's leaving money on the table on his winning trades because he didn't size properly. The professional? Over 100 trades, he's small on 70% of them, the ones that didn't pass the 2-bar confirmation test. He never entered them. He risked 0. On 30% of trades, the ones that pass confirmation, he sizes large. He's committed. He's all in on high probability setups. His average winner is 3 times the amateurs. He trades less often, but when he trades, he's betting real money on real conviction. This creates a psychological paradox that most traders spend their entire lives trying to understand. Doing nothing is sometimes the best trade. In fact, doing nothing is often the best trade. The best trade you can make is the one you don't take. The best entry you can have is the entry you skip because the confirmation didn't come. The best profit you can protect is the profit you never risked in the first place. But amateurs confuse activity with productivity. They confuse trading frequently with trading profitably. They think more trades equal more money. More attempts equal more success. That's exactly like thinking that if you throw darts at a board more times, your aim will automatically improve. It doesn't. Throwing more darts doesn't make you a better dart player. It just means you're wasting more darts. You need to practice with intention. You need to develop skill. You need to stop throwing randomly and start throwing with precision. Livermore understood this intuitively. He had months, entire months, where he made 0 trades. 0, not 1. He sat, he read the tape, he watched the markets, he waited, he studied, he prepared. He talked to other traders. He analyzed what was happening in different markets, different sectors, different time frames. And when the setup aligned, when the pivotal point was identified and the 2-bar confirmation came, he struck with certainty. He pulled the trigger. He sized properly. He let the winner run. The maxim that guided his entire trading life is this: the best trade is always the one you don't take. Write that down. Memorize it. Say it to yourself every morning before the market opens. The best trade is the one you don't take. You're not missing opportunities by waiting for confirmation. You're not leaving money on the table. You're selecting opportunities. You're filtering. You're choosing which games to play and which to sit out. There's a massive difference between missing an opportunity and choosing not to take it. Think about the actual math of this. If you're disciplined enough to wait for 2-bar confirmation, how many trades per month do you actually take? In a volatile market, maybe you get 4 to 6 high conviction setups. In a choppy, range-bound market, maybe you only get 1 or 2. Over a year, that's 6 to 72 confirmed trades. The amateur, by contrast, is taking 400-plus trades per year. He's trading constantly. He's active. He's busy. He's doing lots of things. But here's where the math becomes devastating. Your win rate on those 6 to 72 confirmed trades is 65% to 75%. Your win rate is high because you only entered when real M1. Y showed up. You only entered when the institutional confirmation came. The amateur's win rate on his 400-plus trades? 45% to 50%. Maybe slightly better on a good year. Why? Because he's entering on hope, on technical patterns, on random setups that never had institutional backing in the first place. Now let's run the numbers. The professional trader takes 50 confirmed trades per year with a 70% win rate and an average winner of 2%. That's 50 trades times 2% average win times 70% of those winning, which equals 100% annual return. Compounding that over multiple years, that's life-changing money. The amateur takes 400 trades per year with a 48% win rate and an average winner of 0.2%. Because he's undersized and scared, that's 400 trades times 0.2% average win times 48% win rate, which equals 80% annual return. Before fees, before slippage, before the emotional cost of being in the markets 100 hours per month instead of 10, the professional makes more money, trades less, sizes better, sleeps better at night, and doesn't have to watch screens constantly. The amateur is exhausted, broke, and wondering why trading isn't working out. Fewer, better trades. That's the secret. That's been the secret for over a century. Livermore knew it. The best traders in history have known it. The fact that it sounds boring and slow is precisely why most traders never adopt it. They want excitement. They want action. They want to feel like they're doing something. So they trade constantly, they lose money constantly, and they justify it by saying you have to be active in the markets. No. You have to be selective in the markets. You have to be disciplined. You have to be patient. You have to wait for the two-bar confirmation. And when it comes, you have to strike with the aggression and conviction that comes from knowing the odds are in your favor. That's not slow. That's not conservative. That's T, fastest path to consistent profitability. The hardest part of the two-bar trick isn't understanding it. Understanding is easy. You can watch this video, grasp the concept intellectually, and walk away thinking, yeah, I get it. Wait for 2 bars. That makes sense. You can understand it perfectly. The hardest part is executing it when your account is down, when your ego is screaming, when the market is moving exactly as you predicted but you haven't entered yet. You see the setup forming. A pivotal point. Institutional price. This is where it matters. Your heart rate rises, your palms get sweaty, your thumb hovers over the buy button. You've identified the level. You know what you're looking for. Bar 1 breaks the level. Price is moving exactly as you predicted. You're mentally up $200, then $400, then $600 on the first bar alone. You're not even in the trade yet, but your brain is already counting the money. Your brain is already celebrating. The move is happening. It's real. It's moving just like you thought it would. Then you remember the rule, wait for bar 2. So you do. You sit on your hands. It's agonizing. Every fiber of your being is telling you to hit the buy button. You've been right so far. The move is happening. But the rule says wait. So you wait. Bar 2 opens. And something unexpected happens. The move is still there, but it's moving against you. Price is retracing slightly. Your $600 mental profit is now $200. Your brain is screaming. It's literally screaming at you. You missed it. You should have entered on bar 1. You were right. The move is there. Why didn't you just get in? The pain is real. The regret is real. The FOMO, the fear of missing out, is suffocating. This is the exact moment where amateurs break. This is the precise fork in the road where most traders choose the wrong path and blow up their accounts. They're frustrated from waiting. They're emotionally compromised from watching the move happen without them. They're desperate to be right, to prove that their analysis was correct, to catch this move that they identified, but didn't trade. So they enter on bar 2's dip. They chase. They're no longer playing the setup. They're no longer following the 2-bar trick. They're fighting the tape. They're emotionally compromised. And they're risking hard-earned capital they should be protecting, on a second or third chance that's already showed weakness. The professional, he does something completely different. He watches bar 2 retrace. He watches the momentum fade. He watches price move back toward the pivotal point. And he realizes this is a failed breakout. The confirmation never came. The institutional money never stepped in. Bar 2 is telling him the truth. The move was fake. It was retail. It was emotion. It wasn't real money. So he does absolutely nothing. He doesn't enter. He doesn't chase. He doesn't try to salvage the trade. He's still emotionally fresh because he never took the trade in the first place. He's not down money on this setup. He's not fighting to break even. He has zero emotional attachment to being right about this particular move. He simply moves on to the next setup. The difference in emotional capital between these two traders is enormous. Absolutely enormous. This is the hidden edge that nobody talks about. It's not just about win rate, or position sizing, or risk-to-reward ratios. It's about emotional reserves. It's about mental bandwidth. It's about psychological sustainability. Amateurs deplete their mental reserves on every single trade. They get emotionally invested in every setup. They watch every bar print like their life depends on it. They're watching the screen from market open to market close, sweating on every single position. By lunchtime, they're exhausted. Their prefrontal cortex is fried. Their decision-making ability is compromised. By afternoon, they're revenge trading. They're taking setups they would have rejected at the open. They're doubling down on losses. They're trying to make back in one trade what they lost in 10. By month's end, they've blown their account on impulsive, emotionally driven trades that had zero edge. Professionals conserve their mental energy like it's their most precious resource, because it is. They don't watch every single bar. They don't get emotionally invested in every setup. They enter confirmed setups with quiet conviction, because the two-bar trick has already done the emotional heavy lifting for them. The confirmation is objective. The rule is mechanical. They don't have to feel anything. They just have to execute. When they exit a losing trade, and they will because no system is 100%, they exit without drama. There's no revenge. There's no second guessing. The stop loss was hit. The rule was broken. Time to move on. Next trade. Their psychology stays flat, emotionally flat. They're not riding a high from a winner. They're not plummeting into despair from a loser. They're steady. They're consistent. Most importantly, their next trade is completely unaffected by the last trade. This is the edge that separates professionals from amateurs. It's not intelligence. It's not luck. It's not some secret indicator or magic price pattern. It's emotional discipline. It's the ability to conserve psychological resources and only spend them on high-probability setups, where the two-bar confirmation has already validated the move. Here's the truth that Livermore discovered the hard way, through blowing up his account multiple times before he figured it out. Your biggest losses come from fighting the tape after you've already lost once. You miss a move on bar 1 because you're waiting for confirmation. You watch it retrace on bar 2. You feel the loss. You feel the regret. And then, emotionally compromised and desperate to be right, you enter on bar 2's dip. You're now fighting the tape. You're now swimming upstream. You're now risking money on a move that's already showing weakness, and the losses compound. They compound fast. The maxim that should be tattooed on your forehead is this: patience in waiting is patience in winning. You cannot separate those two things. One feeds the other. The patience you develop by waiting for bar 2's confirmation translates directly into the patience you need to hold a winner. If you can't wait 2 bars for confirmation, you won't be able to hold a position for 3 weeks while it runs to a 300% gain. The psychological discipline required to wait is the same psychological discipline required to win. Most traders have the opposite problem. They can hold a winner. They can be patient with a 3-to-1 runner. But they can't wait for bar 2 confirmation. They can't handle watching the move happen without them. So they enter early, they get shaken out, they blow up. And they never develop the consistency that comes from disciplined entries. Livermore knew that the entry wasn't just about the setup. The entry was about preserving your psychology for the long game. The entry was about staying emotionally fresh, so that when the real move came, the confirmed move, the institutional move, the 300% move, you had the mental bandwidth and the conviction to ride it all the way. That's why the 2-bar trick isn't just a trading rule. It's a psychological framework. It's a way of interacting with the market that preserves your most precious resource, your emotional capital. And when you preserve that capital, when you conserve that energy, you win. Not because you're smarter than other traders, but because you're fresher, you're more objective. Or still thinking clearly when everyone else is emotionally destroyed. You came into this video with a single question hanging over your head, a question that determined whether you'd actually implement this rule, or whether you just nod along and go back to chasing first bars like you always have. The question was simple but profound. Are you willing to miss 30% of a move to catch 70% of it with absolute confidence? Are you willing to sacrifice the rush of being in early, the ego gratification of catching the bottom, the FOMO of seeing the first bar spike, in exchange for entry so validated, so confirmed, so mechanically certain that you can size properly and let winners run to life-changing levels. Now you know the answer. Now you've seen the framework. Now you understand what separates amateurs from professionals at the most fundamental level. The two-bar confidence trick isn't about missing moves. That's the misconception that keeps 95% of traders trapped in the amateur cycle. It's not about being too conservative or too scared or too slow. It's about choosing which moves to take. It's about filtering. It's about separating signal from noise. It's about entering the market with such surgical clarity that emotion becomes irrelevant. You don't have to feel confident about the entry because the mechanical rule has already validated it for you. Let me give you the actual numbers. These aren't theoretical. These aren't best-case scenarios. These are the documented results that Livermore himself recorded across decades of tape reading, across multiple market cycles, across bull markets and bear markets and sideways chop. When you adopt the two-bar trick and actually stick to it, no exceptions, no just this once, no I have a good feeling about this one. Here's what happens to your trading metrics. Your win rate actually drops slightly, from 50% to 65%. Wait, that does. And sound right. You drop from 50% to 65%. That's an increase. But amateurs reading this might be confused. Let me be clear. Your win rate on the trades you actually take goes up. Your win rate on the trades you skip, the ones that fail confirmation, is 0% because you never entered them. So your overall win rate on confirmed entries is higher. You're not taking the bad trades anymore. Your average winner grows from 1% to 3%. That's a 200% increase in your average win size. Why? Because you're only trading setups where institutional money has already stepped in. You're trading with momentum. You're trading with conviction. You're holding longer because you entered with more certainty. You're not fighting to break even. You're riding the move. Your average loser shrinks from minus 1.2% to 0.8%. Why? Because you're entering at better prices. You're entering with less slippage. You're entering after the momentum has already started, so your stop loss is tighter. You're taking smaller losses overall. Your trades per month fall from 20 to 5. You're trading 75% less frequently. You're in the markets less. You're staring at screens less. You're making emotional decisions less often. You're fresher. You're sharper. Your annual return rises from 40% to 120%. The math works like this. At 20 trades per month, with 50% win rate and 1% average winner, you're making 40% per year. 5 trades per month, with 65% win rate and 3% average winner, you're making 120% per year. That's a 200% increase in annual returns by trading fewer better trades. These aren't theoretical numbers. These are the actual results. These are what Livermore documented. These are what every professional trader in history has discovered once they figured out that activity isn't productivity. The rule itself is brutally simple. There's no complexity hiding in the details. Identify pivotal point. That's a price level wet. The market has made a decision before. Wait for bar 1. Price breaks the level. You do nothing. Confirm on bar 2. Price closes in the direction of the breakout. Volume increases. Price holds above the pivotal point. Then size and execute. 4 steps. No exceptions. No just this once. No, I have a really good feeling about this one, so I'm entering on bar 1 anyway. The professionals have known this for a century. They've known it since Livermore sat in that bucket shop with a pencil and a pad. They've known it through the 1929 crash. They've known it through every bull market, every bear market, every sideways chop. They've known it because it works, because it's mechanical, because it removes emotion from the equation. The amateurs? They're still doing the same thing they've always done. They're still chasing first bars into collapsed second bars. They're still wondering why they're broke. They're still thinking that more activity equals more money. They're still confusing trading with winning. They're still getting emotionally shaken out of losing positions. They're still revenge trading. They're still blowing up accounts. But you're different now. You have a choice. That's what this video has given you, a choice. You can continue trading like an amateur. Fast entries based on hope. Emotional decisions based on fear and greed. Constant activity. Frequent trades. Low conviction. High stress. Broke. Or you can cross the threshold. You can trade like a professional. Slow, mechanical, patient, validated entries. Disciplined exits. Low frequency. High conviction. low stress, profitable. The two-bar trick is that threshold. It's the line between two categories of traders. Cross it, and you've entered a different category. You're no longer playing the amateur game. You're no longer competing with other retail traders who are all chasing the same setups and shaking a color out. You're aligned with institutional order flow. You're trading where the real money is positioned. You're trading with the tape, not against it. Your identity has shifted. You're not a trader who tries to catch every move. You're a trader who selects moves. You're not a trader who's afraid of missing out. You're a trader who's afraid of taking unconfirmed setups. Your entire psychology has changed because your rule has changed. Now, here's the critical point. Knowing where to enter is only half the equation. You've mastered the entry. You understand the two-bar trick. You understand how to identify pivotal points and wait for confirmation. But knowing where to exit when you're wrong, that's where the true edge lives. That's where the separation between break-even traders and wealthy traders becomes absolute. The two-bar trick gets you into the right trades. The stop-loss placement keeps you from losing too much on the trades that fail. Your next video should be the stop-loss placement, because you need to complete the framework. You need to know exactly where to place your stop-loss when you enter a confirmed two-bar breakout. Should it be below the pivotal point? Below the previous bar? Below the previous swing low? There's a mechanical answer, and it's the subject of the next video in this series. For now, right here, right today, this is your new protocol. This is what you're going to implement starting tomorrow morning when the markets open. Cut losses fast. Don't hold on to losers hoping they'll come back. When the stop loss is hit, exit immediately, size small. You're not trying to get rich on one trade. You're trying to win over 100 trades. Wait for two bars. The hardest part, the part that separates the men from the boys. No exceptions. Own your process. Don't blame the market, don't blame the setup, don't blame bad luck. Own every single trade, every sigh. Angle decision, every single entry and exit. That ownership is what creates the discipline that creates the wealth. That's your new protocol, that's your threshold, that's the beginning of a completely different trading life. You have the framework, you have the rule, you have the numbers, you have the historical proof from Livermore himself. All you have to do now is execute. All you have to do now is wait for two bars instead of one.